Get on board Amnish Aggarwal. He's head of research at Prabhudas Lilladher, joining in to talk about that. Just to start off with, Amnish, it seems like the overall growth for a PBT level, as per your expectations, is in double digits. There is going to be the factor of the low base, the monsoon. All of that is going to overall aid growth. Give us, in a snapshot or in a nutshell, take us through what you're expecting from the Q3 earnings season.
You see, Q3 is unlikely to give you any green shoots as far as the overall performance is concerned. Whatever growth in PBT is reflected, it is mainly led by financials because of the lower base and some of the write-backs which are expected. So if you remove that, I think some of the sectors which could do well during the current quarter are, for example, financials are there, then cement is there, and I think barring these 2-3, most of the other sectors will remain muted.
What we saw, Amish, for the quarter gone by, which is Q2, that the corporate tax cut was visible. Some companies were able to report differentiated numbers because of the corporate tax assumptions. How exactly do you think the corporate tax benefit would be factored in for the current quarter? Because this is the first full current quarter where they will be able to come out with clean set of numbers. Last time when the corporate tax was announced, it was middle of quarter and every company had a different interpretation of it.
You see, the corporate tax impact would still be visible because of 2-3 factors. One being that in the previous quarter also, not all the companies, they have shifted to the new tax regime. That is one. The second is the companies which are having deferred tax assets and deferred tax liabilities. So some of them have provided fully in the previous quarters, but not all of them. So some of these companies would be having actually the write-backs coming as far as their tax provisions is concerned, even in the current quarter, and the similar goes for the incremental provisions. Whereas the companies which have already neutralized both these factors, they would, and in the new regime, they would be providing taxation at 25%. So I would say still it is not like it is going to be uniform. So there would be some cases where the taxation will still remain in the old regime. There will be companies at much below 25%, and there will be some companies between say 25 to 30%. So that is why we have been, from the previous quarter itself, we have been concerned more with the PBT growth rather than looking at the PAT growth, because taxation this year is going to be significantly skewed.
Specifically, Amnish, talking about IT, considering later this week you have got, both Infi and TCS delivering their numbers, are there expectations of any positive surprises, or do you think they'll be par for the course inline numbers?
You see, we are not expecting much surprise from IT in the near term, and we are actually underweight on IT because usually in run-up to US elections, so the IT sector usually underperforms and the overall growth rate of the companies also suffers. So we are not expecting any positive surprises to come from IT sector.
Okay. We've spoken about IT, but where do you think the disappointment could come in? Will it be in autos? Will it be in banks because of all kind of write-downs like DHFL Cafe Coffee Day? Or will it be in consumers where the base effect has now kicked in?
I think it will be very, very stock specific. For example, if you are talking about say banks, while some of the private banks, they will continue to do well, there could be some still some skeletons in the cupboards which can come out, like DFHL is something which is known, but there could be some more incremental provisioning which might be required. Similarly, when it comes to your autos, I think we might have seen the worst. QOQ, there might be some improvement which is visible and the base effect is favorable. But I believe we are not yet out of the woods because the BS6 implementation is still some time away, and so as of now, it's difficult to say that whether we have actually seen the bottom. For some segments, maybe say passenger vehicles like your cars, but for say broader two-wheelers or commercial vehicles, I think we are yet to see the actual bottom being made. Now, as far as your other segments of consumption are concerned, I think it is going to be very, very mixed. Some of the companies, we might see some sequential improvement happening, say for example, companies like say your Kansai, but paint companies in general, or broadly I would say that we are not yet out of the woods, and the growth rates definitely are going to be lower on YOY, and in some cases even on a QOQ basis the volume growth will be lower.
Okay, I want to talk in specific about the capital goods sector then, Amnish, because we have seen the order activity, overall execution, that seems to have moderated due to the lower capital expenditure by the government. What is it that you're expecting in terms of management commentary on order growth for the likes of L&T and even some of the other capital goods counters?
You see, the government is actually now in a mode to cut the capex, because if you look at Q3 capex on a QQ basis by the government is down by approximately 5%. And looking at the fiscal condition where you are already running ahead of your fiscal numbers, the tax revenue collection has been very poor. I don't foresee any significant pickup happening on the government side as far as the capex is concerned. When it comes to the private sector, again your capacity utilization is not even 70%, and looking at the cash flow condition of corporates, I don't think we would see any big revival happening from the private sector as far as the capex is concerned. So the capital goods sector will remain more or less a longish term story. The government is showing its intent to develop the infrastructure, but your expenditure might be slightly back-ended. The order inflow in the near term can suffer for sure, but in the longer term, the companies which are having, say, stronger balance sheet and good visibility, they will thrive.
Okay, that's a word coming in on capital goods. A sense as to what the outlook is when it comes to metals, because it is expected to be a fairly strong quarter. We have seen a fall in the overall domestic steel prices. After that consistent fall, rather, we have seen some sort of a pickup. What kind of a trend are you expecting from the metals companies?
You see, metal companies would be, I would say, mixed ones. Okay, so we are not very positive on the metal companies because it depends on how the global prices behave. So currently for some of the segments the prices have come up, and that is also reflected in the stock prices. So there might be some steam which is still left, but over the medium term we are not very positive on the metal companies per se.
Okay. I was curious as well to understand pharma. It's likely to see pressure from, the US generics market, the price controls. All of that is expected to lead to a fairly tempered Q3 for the pharma companies. What is it that you're pricing in?
You see, the pharma sector continues to suffer from the issues which the various companies have with US FDA. So at some point of time or the other, I think there will be hardly any pharma company which today is not having an issue which is impacting the overall growth rate. As far as the domestic business is concerned, the pharma companies are doing reasonably well. The growth rates for most of the companies would be at least in the mid to high single digits. So that's the reason the MNC pharma, which are more domestic focused, they have done better. As far as the Indian pharma companies are concerned, I think even in the near to medium term, they will continue to be impacted by your issues related to US FDA. And that is the reason why we are not positive on the pharma sector. Dr. Reddy's is the only stock which we have in our model portfolio.
All right, Amnish, thank you for sharing with us your outlook on the earnings and giving us an extensive view as to what we're expecting to see this time around from individual sectors as well.